Hold on, what if I told you that one of the world's tech giants just made a move that could shake the very foundation of the AI industry? Imagine Meta, the social media behemoth, secretly eyeing Google's chips over Nvidia's, and the implications are wild. Let's dive into the details. Recently, Alphabet surged by roughly 4%, while Nvidia experienced a similar percentage decline amid growing concerns about intensifying competition in the AI chip market. And the buzz began when reports emerged that Meta is seriously considering using Google's custom AI chips for some of its operations instead of Nvidia's widely adopted solutions. If you're wondering whether this spells trouble for Nvidia or marks the onset of an AI bubble, and if it should influence your next investment move, you're in the right place. Now, let's set the stage. We're in an era where artificial intelligence isn't just the future, it's the present, rapidly transforming industries from healthcare and finance to gaming and social media. Every day, we hear buzz about groundbreaking developments, and today's headline might seem like a setback for Nvidia. But before you start panicking or thinking that an AI bubble is about to burst, take a deep breath. The situation is a lot more layered than it might appear at first glance. First off, remember that while Nvidia has indeed fallen about 4% in the wake of these reports, the broader context shows something very different. The overall demand for AI computing power is skyrocketing. Reports indicate a year-over-year increase of anywhere between 50% and 70% in AI compute demand. That's a massive jump and a statistic that hardly supports the notion of imminent market collapse if you're an investor. You should note that such explosive growth in demand is one of the key reasons why many believe that the AI sector remains a phenomenal opportunity. It's important to remember that even with this recent shakeup, Nvidia still dominates about 90% of the global AI chip market. That means despite the whispers of new competition and market shifts, Nvidia remains the undisputed powerhouse, often referred to as the arms dealer of AI. This label isn't just catchy, it's a reflection of Nvidia's formidable influence in powering everything from data centers and self-driving cars to high-performance computing systems. So what do these numbers mean for you? What are the real implications of Meta's potential chip strategy shift? And most importantly, is this all just smoke and mirrors fueling an AI bubble, or is there a smoke signal of opportunity here? At its core, the story plays into what every investor needs to understand. Market headlines can be enticing, but they often mask the deeper fundamentals. Let's break down some of the key aspects of this unfolding drama by looking at the players, the market dynamics, and the strategies that might be in play. Consider Meta's potential decision to opt for Google's AI chips. This move might initially appear as a direct hit to Nvidia's monopoly in the space. However, when you examine the broader market, it becomes clear that the story is much more nuanced. There's reason to suspect that Meta isn't necessarily rejecting Nvidia's technology because it's obsolete, but rather because it's exploring how different types of AI chips can better address its specific needs. In today's competitive tech environment, even giants like Meta continuously look to diversify their partnerships to mitigate risks and maximize performance. Historically, companies with deep pockets often spread their bets across multiple vendors to ensure they're not overly reliant on a single source, especially in something as critical as AI infrastructure. Now, let's talk about the numbers behind this narrative. Nvidia's share of approximately 90% of the global AI chip market suggests that the company enjoys a near monopoly in this niche. It's a position that didn't come overnight. It was built over years of innovation, strategic investments, and capturing emerging trends at just the right moment. Yes, the recent news about Meta might have rattled the market in the short term, but a drop of 4% is hardly a death knell. Commodity markets have their ups and downs, and in many cases, a temporary dip can actually set the stage for a more robust rebound once speculation cools down. Let's take a closer look at AI compute demand. Growth figures of 50% to 70% year over year tell an exciting story, one where the appetite for computational power is growing so rapidly that there simply isn't enough capacity to go around. In this environment, even with new competitors entering the scene, Nvidia's technological edge, established partnerships, and the sheer volume of applications that rely on its chips provide a cushion against drastic declines. Think of it like a luxury car with specialized features. It might face competition, but its performance and prestige keep it in a league of its own. For a moment, let's entertain a contrarian perspective. What if this news is overhyped? What if Meta's move is more of a tactical diversification rather than a repudiation of Nvidia's technology? It's possible that in the frenzy over emerging AI trends, investors might be misinterpreting strategic maneuvers as existential threats. In reality, tech companies like Meta often hedge their bets to test multiple options, ensuring that they remain flexible as AI applications evolve. This isn't a tale of one giant toppling another overnight. It's a carefully choreographed dance in a rapidly changing market where every step is as crucial as the next. So, where does this leave us regarding the notion of an AI bubble? Is this the moment to jump in, or should you maintain a cautious stance? Let's break down the concept a bit further. An investment bubble typically relies on inflated expectations, where the market is sold on the promise of an entire revolution, only for the fundamentals to eventually catch up. In the case of AI, many signals suggest that we're dealing with genuine transformative technology that is already changing everyday operations across industries. The surge in compute demand, matched with consistent technological breakthroughs, indicates a market that is, if anything, undersupplied in capacity rather than experiencing an unsustainable bubble. Yet, it's vital to distinguish between hype and fundamental value. Yes, the AI narrative is overblown in certain media outlets, with every announcement touted as the next big revolution. But behind that layer of hype is the solid reality of incremental progress. A reality where improved algorithms, specialized hardware, and refined software are gradually transforming business models worldwide. Investing based purely on hype is a risky move. Instead, it's instructive to look at metrics like revenue growth, R&D investments, and the scalability of the technology. Nvidia's record shows that it is well situated to meet the surging demand, even if new competitors are testing the waters. Imagine you're at a busy coffee shop and overhear conversations about the latest gadget or trend that everyone is raving about. Your immediate reaction might be to wonder, is this the real deal or just another fad? That's the same question investors and tech enthusiasts alike must ask when looking at dramatic market moves. The current scenario isn't just about one company's stock price fluctuating on a rumor. It's indicative of a broader shift in how technology, finance, and global innovation intersect. And for you watching this, it presents an opportunity to dig deeper, ask smart questions, and potentially position yourself in a sector that's on the cusp of significant evolution. It's also essential to highlight that while Meta's decision is noteworthy, it doesn't necessarily spell doom for Nvidia. Despite the increased competition, Nvidia's technological prowess, established market share, and ongoing investments in AI development keep it as a central player in the industry. Think of it like a seasoned quarterback who's been dominating the game for years. Every now and then, an opponent might exploit a weakness, but overall, the player adjusts and comes back stronger in subsequent seasons. Moreover, consider the larger context of AI chip development. New entrants might bring innovation, yes, but they also have to contend with significant barriers such as research, costs, supply chain complexity, and the need for robust ecosystems. Nvidia's strength lies not only in its hardware, but in the comprehensive ecosystem it has developed, ranging from developer tools and innovative software frameworks to strategic industry partnerships. This ecosystem is reminiscent of a well-oiled machine that has evolved over years, making it hard for newcomers to replicate overnight. Now, let's pivot to the investment angle, which ties directly into your question. Is this an AI bubble? Why do you need to get in now? One perspective is that entering the AI space now could offer tremendous rewards as the technology underpins a massive and growing market. With AI compute demand outpacing traditional growth forecasts, the opportunity available might be akin to getting in early on the next big tech wave. However, it's a nuanced calculation. There's a devilish mix of timing, risk tolerance, and understanding the real value behind the hype that every investor should consider. I'm reminded of an instance early in my career when I sprinted to invest in a booming tech stock based solely on the buzz, only to see it plateau after the initial excitement faded. That experience taught me a crucial lesson. Always look beneath sensational headlines and trust the underlying data. For you, the takeaway is clear. The evolving dynamics between companies like Meta, Google, and Nvidia should prompt you to scrutinize the fundamentals. Is the market truly overvalued, or is it simply evolving in ways that make it appear more volatile in the short term? Let's examine a couple of concrete examples to illustrate these points. Take Nvidia's, for instance. Despite recent fluctuations, Nvidia has continuously ramped up its research and development. It's not content to rest on its laurels. The company is actively exploring new areas such as edge computing, autonomous driving, innovations, and high-performance data center solutions. Each of these represents a pathway to sustained demand, reinforcing Nvidia's position even if competitors start to chip away at specific segments. It isn't just a chip manufacturing business, it's a powerhouse driving AI transformation across many verticals. Contrast this with the story of past technological bubbles. Remember the dot-com era? Certainly some companies were drastically overvalued, leading to a harsh correction, yet the survivors emerged stronger and more innovative. What differentiates the current AI market is that its growth isn't based on empty promises or untested business models. Instead, it is built on robust technological innovations that are already fueling practical applications across critical sectors. It's akin to having a skip in a river. While there are ripples and occasional splashes, the overall current is strong and persistent. Of course, it's natural to be cautious in times of such pronounced technological shifts. After all, no one wants to buy into a bubble only for it to deflate unexpectedly, a painful scenario that countless investors have experienced before. But if we look at the long-term trajectory of AI and its integration into everyday technology, the signs point to a market that's more evolutionary than revolutionary. Essentially, you're looking at an industry that is in its growth spurt, not one that's inflated by baseless hype. You might be asking, how can I tell when it's time to invest, rather than succumbing to fear or blind optimism? The answer lies in diligent research and an understanding of market cycles. One strategy is diversification. Instead of placing all your bets on a single company, consider a portfolio that captures different facets of the AI ecosystem, from chip makers like Nvidia to companies building on top of these chips, and even those creating complementary software and services. This balanced approach can shield you from potential volatility while still allowing you to benefit from the broader trend. Let's also talk about risk management. Every technological innovation brings uncertainty, and AI is no different. While the current market may present sensational headlines, the importance of due diligence cannot be overstated. Investors should be wary of letting emotions drive decisions. Instead, focus on understanding whether the companies you're considering can continually innovate and maintain competitive advantages. Ask yourself questions like, do they have a proven track record in R&D? Are their products scalable and adaptable to future technological shifts? How do they fare in the global competitive landscape? There's also an intriguing debate emerging around the term arms dealer of AI. Some critics argue that labeling Nvidia this way overstates its role, especially when diverse sectors from automotive to cloud computing are developing their own unique hardware solutions. However, this narrative can be misleading. While it's true that more players are entering the scene, Nvidia's comprehensive portfolio and performance consistency put it in a uniquely strong position. Think of it as comparing a master chef versus a new cook, experimenting with trendy recipes. The old guard might have occasional moments of brilliance from the newcomer, but the seasoned expert consistently delivers excellence. So, what's the actionable insight for you as a global finance enthusiast? It's simple. Look beyond the immediate headlines. Understand that while market dynamics can shift rapidly and stocks like Nvidia might see short-term volatility, the underlying fundamentals are robust. The burgeoning AI compute demand is more than a fleeting trend. It's a signal that industries worldwide are accelerating their adoption of AI, and that the companies positioned at the heart of this transformation are likely to be major beneficiaries in the long run. If you're considering an investment in AI, the best approach is to adopt a long-term view. Watch for companies that not only lead the market today, but are also poised to innovate on the next wave of AI development. This means keeping an eye on emerging technology trends, monitoring R&D investment patterns, and understanding how global, geopolitical, and market forces might affect this space. It also means having a healthy skepticism when sensational headlines come your way. Ask probing questions and seek out detailed analyses rather than relying solely on quick media bites. Let me leave you with this takeaway. Every market shift, every headline, and every moment of uncertainty presents both a risk and an opportunity. If you're truly excited by the future of AI, the key is to balance your enthusiasm with cautious optimism. Ensure that your investment decisions are backed by solid data, sound research, and a clear understanding of the competitive landscape. Picture the modern financial world as a bustling metropolis at night. The bright neon signs grab your attention, but true insight lies in the streets, in the rhythm of everyday business transactions, in the quiet innovation taking place behind the scenes. Investors who succeed are those who can see past the dazzling lights and appreciate the steady pulse beneath, the fundamental trends that drive sustainable growth. Before we wrap up, let's revisit the core question: is this an AI bubble? And why should you get in now based on the current evidence? It's not about jumping into a bubble punctured by unsustainable hype. It's about recognizing that AI and its crucial computational backbone is an engine of progress. Yes, there may be ups and downs along the way, and not every headline will translate to immediate gains. But history shows that transformative technologies eventually reshape our economies, even if the path is sometimes rocky. So, as you evaluate your next moves in the tech and investment arenas, remember to dig deep, seek clarity in the noise, appreciate the nuance behind every market move, and most importantly, maintain a long-term perspective. Whether you're considering a direct investment in companies like Nvidia or interested in new players entering the market, your strategy should always be rooted in rigorous analysis and cautious optimism. In the end, the evolving narrative around Meta, Google, and Nvidia isn't a harbinger of doom. It's a snapshot of a dynamic industry undergoing rapid transformation. It's a reminder that in the world of finance and technology, change is the only constant. And for those willing to navigate these turbulent waters with a discerning eye, the potential rewards are boundless. Until next time, happy investing and keep that discerning mind active.